pricing and valuation of bonds. So first of all, let's understand as to why do we need pricing and valuation of bonds. And that is because there is a set of people for whom fixed income securities or bonds are a source of income. And that means what? That means it is their business to deal in fixed income securities. And obviously, if they have to deal in fixed income securities, their driver is to make profit out of those transactions that they do in fixed income securities. We already are aware that the size of the fixed income securities globally is of $300 trillion. And that means you can imagine the mammoth size of the transactions that must be taking place globally as far as the fixed income securities are concerned or as far as the bonds are concerned. And therefore, if someone has to make in profit out of dealing in fixed income securities, that person or that set of people got to constantly keep on pricing the securities, keep on valuing them, and based on that, keep on taking a decision to divest or to invest or to hold. And at the same time, let me also tell you, since the size of the bond market or debt market is of $300 trillion, the number of players which are there is again a very huge number, very large number globally. And the category of the players which are there in case of debt market, it will include all kinds of wealth managers, all kinds of funds manager, be it a mutual fund, be it a private equity fund, be it a pension fund, be it a government treasury, be it a corporate treasury. So all of them have to continuously keep on figuring out the pricing and the valuation of different securities that they may be dealing in. Incidentally, pricing and valuation of fixed income security is not that complex a matter as one would think. Typically, we don't deal into the fixed income securities, all of us, day in and day out, and therefore we tend to think that pricing of a fixed income security may be a complex matter. But let me tell you, it is not a complex matter at all. And why it is not a complex matter at all? And that is because how we would do pricing or valuation of a fixed income security. We will do pricing or valuation of a fixed income security following the principle of discounted cash flow. So how do we use the discounted cash flow for the purpose of valuation of a business unit? Same way we will do the valuation of a fixed income security by discounting the future cash flows. And which are the future cash flows in case of a fixed income security? Again, it is very simple. So when you invest into a fixed income security and that security is having a tenure, let's say of 7 years, now what is going to be your cash flow on that security, assuming that you hold it for till the time of maturity? So what is going to be your cash flow on that security? Your cash flow, number one, is going to be by way of interest for next 7 years. And at the end of 7th year, you will also get your principal paid back to you. So that is your cash inflow on this security, on this fixed income security. And now what do? Now you simply discount this cash flow by your cost of capital or by your discounting rate or by your market rate or by your target rate or by your expected rate of return, as we discussed the other day. एंड जब आप ये फ्यूचर कैश फ्लोज को डिस्काउंट करोगे बाय योर कॉस्ट ऑफ कैपिटल और योर एक्सपेक्टेड रेट ऑफ रिटर्न, what you will get in your hand. So the total of all the present values of all the cash flows on this fixed income security is going to be the price or the value of this security. So this is the fundamental driver or fundamental method or fundamental approach that we deploy, that are deployed for the purpose of pricing and valuation of bonds and fixed income securities.